in terms of an update, there's not a great deal to update you on, to be honest, in terms of the positioning of the trust. It remains a very high conviction global portfolio, well diversified both from a country point of view and from a sector standpoint also. As at the end of the first quarter, there were 18 bond holdings making up around 7% of the gross assets of the trust, and there were 50 equity holdings. The largest sectors in terms of that equity exposure are technology at 15%, telecoms at 12%, and then healthcare and consumer staples, which each make up around 11% of the gross assets. As at the end of last year, we explained that we had no direct exposure to consumer discretionary companies, and that remains the same. The reason is that we struggle to get the consistent level of income in those types of companies often, and the level of income that we would be happy with. Now, what we are very aware of is that we do have indirect exposure to that category through the trust's largest position. That is a company called Doceo, which is a Mexican airport company which is heavily reliant on tourism. So that certainly taps into an element of discretionary spending, which we're happy with. The only other thing to mention is that the level of dispersion is great. So within those 50 equity holdings, that's got exposure to 23 different countries. Roughly 25% of the trust's assets are in each of Asia, North America and Europe. We have around 14% in Latin America currently, 5% in the UK, and then around 7% in those fixed income bonds. And even within the fixed income element of the portfolio, that's spread really nicely. So we have 7 different countries represented there, and relatively small positions in each of the fixed income positions that we have. Those are a mix of government bonds and high quality corporate bonds. And just to reiterate again, I'm sure you've heard it many times, but the positioning that we end up with is a result of where we see opportunities at the stock level, rather than trying to take a view on any particular sector or region and then find the companies to fit that view. The trust has performed pretty resiliently so far this year. The share price is up slightly on the quarter, and there is no significant discount or premium to mention as at the end of Q1, with the share price and the NAV roughly in line. In terms of the underlying positions, there's always a dispersion of returns. So in terms of what has worked well so far this year, this trust's biggest position that I just previously mentioned, Doceo, has had a very strong start to this calendar year, up 28% in sterling terms over the first 3 months. And that's very much part of the ongoing recovery from COVID, which is still underway. And what we're seeing is very strong demand. Passenger numbers are up strongly, even on 2 years ago, 3 years ago, as that demand for tourism is still very strong. So it's something that we are mindful of. There's potentially more tough times to come for people, but in terms of what people want to spend their money on, holidays is still up there, and Doceo is benefiting from that. Another portion of the portfolio which has performed very well year to date is a number of the semiconductor holdings that we have in the trust. These are cyclical holdings, and we did see weakness in some of these names last year, but the recovery started last November, and that has continued into this year. If you look at the underlying performance of the businesses, it's interesting because sales are still quite weak overall, but what is happening is that we're starting to see some early indications of demand stabilising. Margins are being well managed, and there is general investor expectations of a pickup in demand for semiconductors in the second half of this year. And what we often find is that the share prices move quite far in advance of that actually happening. So those companies like BE Semiconductor, Taiwan Semiconductor and Global Wafers are all up 20% plus in sterling terms in Q1. And now offsetting that, areas of more weakness have been some of the more defensive categories, things like British American Tobacco and Philip Morris have been relatively weak year to date, down about between 5 and 10% in sterling terms. These were very strong performers last year in a down market, so I think it's partly to do with that. Also, some of the healthcare names, which had been very, very strong last year, again, more defensive types of businesses, those have been a bit weaker year to date also. So a bit of a balance in terms of what's been going on if you lift the lid and actually look to see what's happening within the trust. Well, trading this year so far has been quite light in the trust. We have taken action on that big position, Grupo Asur, as it has performed so strongly. On a couple of occasions, it's went above 5% of gross assets, and we have a guideline that 5% is the maximum position we would have in any one stock. So we have taken some profits in Grupo Asur in February and in March this year to bring it back below that 5% level. That's a discipline that we're very happy with. We're happy to abide by. We've also completed the sale of 2 small holdings in the trust. We initiated these sales at the tail end of last year, and because they're smaller, more liquid positions, they did take a while to complete. The 2 names were Indo Cement and Lotus Retail, which is a Thai real estate property company. Both positions had been pretty weak during COVID, but there has been an element of recovery in these names now. And we just thought there was better opportunities elsewhere, and mindful of the liquidity of these positions. So we reduced those positions and then sold out in the early part of the year. I thought it might be useful at this point to discuss what banking exposure we have in Murray International. It's a question that's been coming up quite a lot from shareholders, given recent events. So there are 4 banks within the trust, which make up about 6% of the gross assets in total. And now that compares pretty much the same as the reference index, which also has 6% in banks, although the composition is pretty different. And actually 3 of those 4 names have acted as if nothing has happened, and they've been pretty immune to recent concerns around banking and what may happen going forward. One is a bit different, but I'll go through each in turn. So the largest position in terms of the banking exposure within Murray International is OCBC of Singapore. And this is actually a stock that I discussed 6 months ago in this type of review. Because it is a stock which is often overlooked in the trust. It's pretty dull, pretty boring, but that's very good, in our opinion, for a bank not to be doing things that are too exotic or too out there. So this has been a very strong performer for us. Last year, it was up strongly. And this year so far, it's been pretty flat. So compared to what's been going on elsewhere in banks, globally banks are down about 6% in Q1. It's actually stood up absolutely fine. It pays a dividend yield of around 5%. So it delivers on that income side as well. So no concerns about OCBC at all. We also have 2 small positions in a couple of country banks. We have SCBX, which is a relatively small Thai country bank, which again dances to its own tune really. It doesn't have any big connections with other financial institutions elsewhere. And similarly, Banco Bradesco of Brazil is also a bank which focuses purely in its home market, and doesn't really have too many links elsewhere. So these stocks, these 2 country banks, can sometimes be volatile, but it's determined by what's going on locally. It's determined by macro events sometimes for those 2 countries, rather than being part of a bigger situation in global banks. The last one to mention is Nordea. This is a 1.5% position in the trust. And this is the one which is based in Europe. So it has been weak on the back of some issues that have been going on in Credit Suisse in particular. This is a Scandinavian bank. And this is one that we introduced a couple of years ago now, added to it 12 months ago when Europe as a whole was pretty weak. And when we've taken a look at that one, we're not overly concerned about the weakness. It fell about 17% in March, but it had been extremely strong up to that point. It was trading at an all-time high as at the end of February. And actually that decline in March is half due to a big annual dividend payment, which happens at that time. And so we have monitored the position. Aberdeen have met with the company recently to make sure that we are still comfortable with the quality of the bank, where it lends, etc. And we are. But just given recent events, we will be keeping a close eye on that stock in particular. So as always, the main focus does still seem to be interest rates and inflation. In terms of different parts of the world, what's going on and what the future may hold for these two issues. Now, we don't have any special insights into these things. We do have teams of people within Aberdeen who are very knowledgeable, and we can tap into that if we wish to do so. But the focus for us remains on finding companies that we feel are financially strong to start with. So then they are not at the mercy of having to renew debts and potentially have to do so at a much higher cost. They don't have to come to the market for equity financing when perhaps it's not the best time to do so, or issue bonds when it's not the best time to do so. So we love companies with financial flexibility, always, not just now. So cash flows and balance sheet strength are something that we think are just as important now, if not more so, than they ever have been. And we want companies in this uncertain time going forward to be managed by people who have experience and have come through times of difficulty in the past. So again, that's something that we've always looked at, and going into what could be quite turbulent times going forward, we think that's a very valuable quality to have with the management team. And also going forward, we try to step away from a lot of the noise and the headlines and focus on what the investment mandate is of the trust. So that is trying to deliver an above average dividend yield and grow that income and grow that capital in time. So that's a very clear remit. We love having the flexibility that we have in order to try and achieve that. And I think, again, perhaps more than ever, having that global ability to move where we think the best companies are and the best opportunities are is very important.